So I'm very excited to be here today to talk about investment opportunities in Africa. So let me introduce our panelists. To my immediate right is Shaluba Mawela. Shaluba is the founding and managing partner at Shiamo Impact Partners, a pioneering impact advisory and boutique asset management firm that focuses on driving impact investing. The firm actively manages allocations from two angel networks of 36 African women who invest using a gender lens. To Shaluba's right here is Kim Kamarebe. Kim is the founder and managing director of Inua Capital, a gender lens fund manager which manages impact investment funds that invest patient and flexible risk capital in local Ugandan small and medium-sized enterprises across all sectors, with the explicit intention of creating decent jobs and driving sustainable economic development. And then over at the end is Anne Njuki. Anne is founder and managing director of Sayuni Capital, an impact fund that lends to and supports profitable small and medium-sized businesses owned by female and local entrepreneurs in East Africa. Sayuni is focused on the end-to-end consumer value chain in agribusiness, manufacturing, distribution and logistics, and trade, among other fields. So thank you all for joining us today. So I wanted to start, by a very general question about what are the most significant trends you're seeing in your markets, in the markets you work in, and how is that influencing what opportunities you see in investing your funds? Who would like to start on that?
I was going to ask him to start, but I think I'll go ahead. Good morning and greetings to everyone. We're so honored to be on this panel, really sharing about a continent that we're deeply passionate about, and that is one that is so beautiful. Just to add to the intro, I lead an organization called Shiamo Impact Partners. Shiamo is a Tswana word, which means goodness, which really speaks to the values within the organization and how we think about the deployment of capital within our market. We're currently also in the process of fundraising for a $22 million fund and currently have $4.8 million invested, one from a foundation endowment along with a local DFI. So we're really honored to be here, given the work that the organization really is aspiring to doing. And then I think from a South African perspective, South Africa is a very interesting country and currently is at a very pivotal inflection point. We've got solid economic growth, power stability has taken place. We're seeing really big increases in investor confidence as it relates to the African continent. We've seen our currency also strengthen. However, South Africa is also complex in that, one, we've got the highest unemployment, one of the highest unemployment rates globally, with over 33% of people within the country currently unemployed, 46% if we look just at the youth unemployment rates. Secondly, we've got the largest inequality in the world globally, and then we've also got really alarming poverty rates. And so I think for us, given these fault lines that we're seeing within the SA market, that's how we've really thought about shaping investment into the SA market. And really key for us as we think about our impact thesis is, one, investing to create more employment. And so we're really looking at deploying capital into SMMEs that currently account for 87% of jobs in the local economy. Government is projecting that that number will increase to over 90% by 2030. SMMEs also currently contribute over 40% to GDP, and it is expected to increase between 60 and 80% in the next few years. So I think that's the first aspect. Secondly, given the historic inequalities within the country, really driven by the legacy of apartheid that we've seen, what is key for us is really addressing some of those historical imbalances and hence focused on empowerment as a key area of impact for us. And so gender lens for us is really a necessary area where we do think around our investments. I think I'll stop there and maybe hand it over to Kim or Anne.
Thank you, Shaluba. So, David, thank you for the very gracious introduction. As he mentioned, my name is Kim. I founded and run Inua Capital, which is a gender lens growth capital fund investment manager in Uganda. And if you spend time looking at the globe, Uganda is a very special country. First of all, we're right in the middle of the globe. And it's very little on the globe, but it's packing lots of power. If you look at, for example, we're top 10 producer agriculturally of about 10 crops, whether it's coffee, number one in the world for potatoes or sweet potatoes, bananas, cotton, tea, all crops in which we're in the top 10. We have a very unique position. In addition to the fact that we straddle the equator, we are where the tropics touches the equatorial region. And so we have these wonderful savanna safaris of the big five, but then you also have the gorillas and so on. So we're really, our tagline as Uganda is that we're gifted by nature. And Inua, the word Inua is a Swahili word. It means to uplift. And Inua has a very clear and specific purpose, and that word speaks to our purpose, which is to uplift Ugandans. In fact, our vision is just 5 words: to uplift Uganda, our home. And driving economic transformation in this country and unlocking this value so that our natural gifts can translate into wealth creation is fundamental to what we do. And so we do that as an impact investor essentially by championing entrepreneurship as the vehicle to create sustainable jobs in Uganda. We feel that our 50 million people, what they truly need is for us to build an economy, a private sector-driven economy that avails them a decent life. And so we address this through our 3-pronged impact approach of focusing on economic empowerment, sustainability, and inclusivity. And we invest across all sectors. We have essentially 3 kinds of investment vehicles at the moment. The first is our flagship Evergreen Equity Fund, which we have raised. It's a $10 million fund that invests across all sectors, but focuses on the priority sectors in terms of our sustainable development goals as a country, and unlocking where we have this global competitive advantage. So for example, agricultural processing, manufacturing, given our very big population, tourism, and so on. In addition to that, we, as I've said, focus very much on inclusivity and sustainability. So we manage investment vehicles which focus on sectors and areas where we can have a disproportionately high impact on sustainability and inclusivity through concessional vehicles. So for entrepreneurs or companies that may not be ready for commercial capital, but have a disproportionately high impact in terms of inclusivity, maybe because they're female-led or youth-led, or in terms of sustainability, given that they're green. And so we focus on those sectors with with special concessional vehicles. And then lastly, we're in the process of raising a $20 million private credit fund to focus on the social development sectors. With this new and emerging population and a government that is substantially underfunded, investing in health and education through the private sector couldn't be more important. And so we're raising this private credit fund to focus on those sectors very much informative of this 50 million population, half of whom are under 18, starved of services. So at Inua, basically what we do is we raise and deploy both local and foreign capital with the intention of building a more economically, ecologically, and socially sustainable Uganda.
Thank you, Kim. So I'll speak a little bit about the macro trends in Kenya, and particularly in East Africa, and then how that, I think, really drills down to what we do at Sayuni. So to remind you, Sayuni is an impact-focused private credit fund, and we lend to profitable small and medium businesses in Kenya and Tanzania that are owned by either women or local entrepreneurs. And the genesis of Sayuni was really around the racial justice protests that happened in the US in the summer and spring of 2020. I was, sitting at home at my desk during COVID in Nairobi, and somehow the protests, and particularly George Floyd's murder, hit a very had a very personal effect on me. So I'd lived in the US. My brother is a black man living here in the United States. And I really began to think a lot about injustice and what injustice means to me as a person, and realized that I was very much a part of the problem and less a part of the solution. And the reason is that looking at the way capital is deployed in East Africa, you find that, interestingly enough, less than 20% of the capital in Kenya goes to locally owned businesses. And the problem is even worse for women, where less than 10% of the capital goes to women-owned businesses in Africa. And I think that's really a continent-wide problem. So really decided to focus my time and energy investing in businesses owned by women and local entrepreneurs, and that gave birth to what is now Sayuni Capital. And if you look at Kenya and East Africa, I think we see a number of trends. One is that there's a rising middle class, and this is really driven by productive employment. Two, there's increased urbanization. Lots of people are moving to tier 1, tier 2 cities in Kenya. And then third, if anyone's been to Kenya here, you really know about M-Pesa and how mobile money has changed how people sell, how people provide services as well. And so this has reduced transaction costs and really reduced friction when it comes to moving capital around the country. And so I think these three things have really led to an increase in GDP in Kenya, in Tanzania as well. I think we found that if you look at the combined GDPs of Kenya, Tanzania, and Uganda, these have increased nominally by 35% over the last 10 years. So there's really been a massive jump in GDP. However, at the same time, we still face massive challenges. So, there's really been a large drop in credit. So credit shrunk last year in Kenya by almost 2%. There's rising unemployment. There is, I think, really also challenges when it comes to currency, and that's not unique to Kenya. We see that in many markets. But then despite some of these challenges, we've, at Sayuni, decided to invest in agriculture, in manufacturing, in logistics and trade. And discretely, these are 4 sectors that are growing. So agriculture, for example, contributes to over a third of GDP, 20% of employment in Kenya. But we find that anytime you make or process a consumer good, you need to move it, you need to sell it. So there's also a lot of synergies across these sectors, as well as lots of opportunities for impact and job multipliers across the consumer value chain.
Thanks, Anne. So you mentioned the lack of investment capital going to women. So I wanted to ask about your gender lens investing strategy. So how does gender lens investing affect your strategies, and what impacts are you seeing from your strategies in your investees and in the market at large? Maybe Kim, you'd like to talk about that? Thanks.
Happy to kick off on that. And I think it's important to step back. I think very often people misinterpret what a gender lens is, and I think that, or really sort of define it their own way. So I think it's important to step back and define what a gender lens is to us as Inua Capital, and I think to us as most investors on the African continent, and then explain really how that then translates into what we do on a daily basis. And so if you look at a country like Uganda, it is essentially a patrilineal society, and it has a structure that is as such. And so when you enter an economy as an investor or an economic activity actor, you do not enter a vacuum. You enter an economy that has a certain kind of structure, and how you act as an investor in that structure either furthers and exacerbates that structure, positive and negative, or does not. So in our case, as a pioneer in our market, the first fund manager to domicile locally, building an ecosystem, attracting capital in very large amounts to the country for perhaps the very first time and deploying it, we have the opportunity to really impact the structure, the size, and the growth of our private sector. And with that position, in my opinion, comes great responsibility. It is very important that in attracting and deploying that capital, we try our very best to not exacerbate and accelerate the systemic biases that we see in that market, but to acknowledge them and try to find solutions to, as we expand the access to capital, we're able to do so in an equitable way. Because if we do not do that, if we do not explicitly take that approach, what then happens is that by doing nothing or doing business as usual, but bringing more capital into the market, you exacerbate the biases, you widen the gap of the privileged versus the underprivileged, you widen the gap of lack of access to capital for certain groups. And Anne spoke to it a little bit when she said, only 20% of capital that's coming into Kenya is actually investing in Kenyan-led businesses. That sounds really crazy, but if you're in East Africa, that is absolute. East Africa is the place where if you're an American who wants to start a business, your access to capital is very high. If you're an East African who wants to start a business, your access to capital remains very low. And so it's thinking through such things and ensuring that you're intentional. And just to try to give a quick example is to think through together, when you start a business, the only 4 ways that you can really get startup capital in any sort of economy globally: friends, family, what people like to derogatively call fools, but who are essentially punters, people who take risk, and then in many countries, government stimulus. So those are the 4 ways that a business receives capital and is able to go through the difficult J-curve period, from idea to proven business model, but not making revenue or not profitable yet, to pre-profitability to profitability. In that J-curve, capital needs to come in and no capital can go out. And so you need one of those 4 groups to back you. If you look at a patrilineal society like Uganda, which also happens to be a poor economy, if you're in a poor country, your friends are poor, your family is poor, your government's poor, and your punters poor, right? So you're very much, the natural sources of startup capital and stimulus capital do not exist. You're very much left to your own devices. How then, because in these countries businesses do start up, how then do they do so? In a patrilineal society like Uganda, you can use what you have inherited, right? So if you've inherited a small piece of land, you can sell it or use it as collateral, get some money out of that and start your business. If you're well educated, you can spin a good story in the right kind of language, go to a bank and maybe get a little capital. But what happens to you when you don't inherit anything and when you're not educated? And so what we have seen with businesses is that women are often left out in the cold. They are always stuck in the first gear. They do not inherit anything to get them through that J-curve. They are often undereducated or lesser educated in their families than others, and so they're entrepreneurs without the ability to push their business to success. And if you look at a country like Uganda, which is a highly entrepreneurial country, top 10 in the world, 28% of businesses are founded by women, only 2% of bank portfolios are funding loans to women. And therefore, if I attract capital in the country, I have a responsibility to change that. In Inua's case, we seek to ensure that our portfolio, at a minimum, matches that statistic. So if 28 of businesses are female-founded, at least a third of our portfolio needs to be female-led managers, and we need to female-led businesses, on female-owned businesses, and we need to find a way to do this, either by prioritizing women in our screening process, catalyzing them through giving our concessional funds to accelerate them to investability so that they're on an equal footing as other businesses, prioritizing them for capacity building and mentorship, including them in conversations and rooms where they were not previously, and creating an opportunity for them to compete fairly. And for us, this lens is not just about gender, it's a GDI lens for every group that is excluded and that is disempowered. So really, to conclude, for us at Inua, it's about, as we deploy capital, being intentional about inclusivity.
Chiluba, did you want to follow up?
Yeah, I think Kim has said quite a lot around the importance of gender lens investing and why it is needed, specifically on the continent. I think it's worth highlighting, David, the fact that currently, and I think it's a US-based stats, is 98% of asset management is white males. And so investors generally invest in people who look like them. And so when we talk about the African continent and the fact that between 2 and 6% of women-led and women-founded businesses get access to capital, that correlates with the number of women in investment decision-making roles. And so I think that understanding and that appreciation is really important. And so the work the three of us do really focus around a gender lens is with that understanding in mind. And I think also importantly from a South African perspective is really understanding the legacy that we've had from an apartheid perspective where women were systemically but structurally excluded. So a good example is my gran was an entrepreneur and sold food for a living, managed to raise 4 kids, including my late mom. And as a result, given the legacy and the legislation that was in place under apartheid South Africa, is black women were specifically not allowed to own property or land in their own name. And so when we speak about the need to access financing, the need for collateral, oftentimes you have a grouping of people who actually did not have access to financial instruments, to financial support, were unable to scale up their businesses beyond what they were able to get from friends and family. But oftentimes, to the point Kim made, is friends and family were poor, so weren't able to support in that regard. And so when we think about gender lens investing, it really is about finding ways to support women with capital, but also I think key from at least a South African perspective is a necessary redress that needs to happen. And I think one more stat that I think I can leave the audience with is of all the assets under management currently in SA, only 4% are managed by women. And so when we think about the investment that goes to women-led and women-founded businesses, it's because of the stats that women are essentially not managing capital despite the talent and the interest to do so. So yeah, I'll stop there, David. Thanks.
I also want to move on from startup capital to the problem of the missing middle. So Anne, I want to ask you about this. So walk us through the challenges that founders of businesses face once they've actually gotten off the ground and finding that capital they need to grow or scale their businesses. And are there any approaches you've seen that have helped them bridge the middle gap?
Yes, thank you, David. So maybe we'll start off by defining what the missing middle is. So imagine a pyramid that represents all of the enterprises or companies in an economy. So at the very bottom, you have a large number of small and micro enterprises that likely have revenues of less than $50,000 a year. At the very top, you have large companies, so large corporates that typically generate $10 million and above in revenue and likely need probably $5 to $10 million or so in funding. And you have this large gap in the middle. So these are typically companies that are single member or family-owned businesses. They need roughly $50,000 to about $5 million in capital. And this is what we call the missing middle. And what we found is that these companies are usually too large for microfinance. They've outgrown the friends, family, and Panthers that Kim talked about. But at the same time, they're either too informal or too small to be able to access large institutional capital. So, private equity isn't going to invest in them. Large other institutional banks are very unlikely to invest in them either. And SMEs in Africa form 90% of all companies. They are responsible for 80% of consumer goods. They account for 60% of employment and up to 40% of GDP, depending on the market you're in. And these account for, it's been estimated by MIT, over $300 billion in a financing gap. So if you have all these companies and you have such a large financing gap, why aren't banks getting money to them? And we see 3 issues and 3 barriers that we are working to address at Sayuni. So one is that they typically have very poor financial records and weak credit history. And so they often have either incomplete or inaccurate audited statements. And so what we will do at Sayuni is that we say, look, don't even give us your audited statements. We know they're going to be wrong. Instead, give us a few things, 3 things that you already have top of hand. One, you have bank statements. 2, you have supplier invoices, customer receipts. 3, you have mobile money or M-Pesa transactions. And so we take those 3 things and then use them to build a very strong financial picture of whether or not this company has the ability to pay. Now, when you're lending, you also want to evaluate what is their willingness to pay. And so I remember these companies often don't have a very strong or formal credit history. And so what we'll do is we'll ask the borrower, the entrepreneur, for their personal credit history, and we use that to evaluate their willingness to pay. Because our theory is that if you are a good steward of capital as an individual, you'll also be a good steward of capital as a business. The second barrier that a lot of these companies face is that they don't have collateral. So we've talked about, Shiluba talked about how her grandmother didn't have land. Kim has mentioned this as well. And so a lot of these companies will choose to reinvest, rightly so, their profits into growing and running their businesses because, remember, banks aren't giving them the money. And so they often don't have the land that banks require as collateral. And banks will often require 125 to 150% of the value of the loan as collateral. So for every $1 you borrow, you need $1.50 in the value of typically land. And so we'll do a few things. One is that we'll take senior secured positions, but we'll take collateral as low as 75 or 80% of the value of the loan. 2, we're also looking at receivables, personal guarantees as alternatives to collateral. And then 3, we'll also take third-party collateral. So I don't have land, but maybe Kim's mother has land, so I'll go talk to Kim and ask, hey, can you give me, or can your mother or your father, a benefactor, someone, actually offer land for me to borrow from Sayuni? And we find that this is particularly useful in bringing in women as borrowers because they often don't have agency over land. And so we think these 3 approaches, while not perfect, I think are taking some steps to ensure that a lot of these missing middle companies have access to the credit and the capital that they need to be able to grow their businesses. And so for us, we think about impact for these companies in 3 ways. So 1, are we providing inclusive access to capital? 2, are we professionalizing these SMEs and graduating them to larger and frankly cheaper pots of capital because we don't want them to be missing forever? And then 3rd, how do we then create high quality, sustainable, meaningful jobs for the employees and the owners of these SMEs? And so we're raising a $30 million fund to be able to access the capital that's required to get to these SMEs that are in the missing middle.
Kim, did you want to add anything?
I think that Anne has said it all. All I would say is really just to take us back to the theory and say that SMEs are the bedrock of every sustainable economy in the world. They are the biggest employer in every single sustainable economy in the world. And not only are they the biggest employer, more than 80%. And I hate to admit this in public, but close to 30 years now, maybe I'll say 20 to look younger, but close to 30 years ago now, I did my junior paper and thesis at Princeton University on, I wanted to understand and answer one question. Why is Africa poor? Fine. And how do we make Africa not poor? And who and what are the economies that have leapfrogged from being poor to not being poor in the last 100 years? And what have done that? How have they done that? And it led me to really studying the Asian tiger economies that at the time had done that leapfrog. And it was predominantly based on, in their case, governments investing in triggering growth of the next generation of national titans, triggering SMEs to actually grow. and create jobs and create global relevance and create a global competitive advantage. And I say this because I think that for every person in this room, it's important for us to understand how important this is, how important it is to invest in small and growing businesses in Africa, what it truly unlocks. It unlocks, we talk so much about aid and trade, it unlocks the ability for these governments to self-fund. It unlocks the ability for these countries to create jobs. And when I said self-fund, I mean through taxation and so on. It unlocks the ability for these countries to unlock jobs and for us to stop worrying about the migration crisis of 1 billion Africans being unleashed on the world. They're only leaving because the SMEs in their countries are not being invested in. If we really focus as a community of impact capital providers, social capital providers, in targeting resources to this space, we will see the uprisings and the crime and subside as employment steps in. We will see social services picking up the gap that maybe we feel other countries are. And I just think that we don't take enough time to understand how important it is and what it reverses. And so for me, if I had anything to add to this conversation, it would be that the missing middle in Africa is a global problem. It's a global problem because we do not have, instead of directing capacity to grow self-sustaining businesses in that space, we're directing it primarily to commodities, primarily to aid that don't address the root cause of why these economies are so feeble.
Getting back to the leapfrogging point, I mean, I wanted to return to the top line fact of demographics that we started the panel with. So when we talk about North America, Europe, some countries in Asia, such as Japan, there's a worry about demographics, that the workforce is getting older, there are not enough younger workers to support the welfare services that the country provides. But in Africa, we hear a bright story about how in 2050, it's going to be the largest, and a young population, largest workforce in the world, which sounds like an amazing opportunity for investors. It's also a challenge in that you have a lot of young people who are going to look for gainful employment. So how should investors think about this challenge or this opportunity of Africa having the largest and a young workforce in the world? So maybe Shuluba, you'd like to?
Sure. Thanks, David, for that really important question and for also really highlighting the demographic that is on the continent. So you spoke to the fact that by 2050, a majority of the workforce will be situated on the African continent. And I think that's a really important fact to really stop and pause at, to understand that the majority of people who are expected to be part of the workforce will be based on the African continent. What we currently understand is majority of the population in Africa is young people, so over 60% of the population is under the age of 25. And so when you speak about this growing demographic, this youthful demographic, it is definitely something we do need to be mindful of. As we think about the demographic that currently is on the continent, what's troubling and what's really worrying is over 11 million young people, or graduates specifically, are entering the job market every year, and that's a study from IFC. And of those 11 million graduates that are entering the job market, only 3 million jobs are available. And so you've got this large delta between the number of young people coming into the workforce and the jobs that are able to absorb them. And as a result, you've got this large growing, youthful, disgruntled population that's then sitting on the continent. It obviously results in high levels of poverty, which is something we really need to be thinking about. David, you spoke to the fact that we're seeing in other parts of the world where we've got these aging nations, where in Africa, we're actually seeing a very youthful population. I think Kim spoke to the fact that, one, if we don't address some of the issues that we're facing specifically on the continent, we will have, one, an unemployment issue, given that stats that I quoted earlier, but I think secondly, a migration issue. And so I think when we speak about the African continent, it's not just for Africans to solve, it's actually really a global issue, And I think that's the urgency that we need to think around. There are so many young people on the African continent who don't have jobs, don't have access to income, and so don't have good livelihoods across the continent. And I'd previously done work in South Africa it was a presidential youth campaign, which was really aimed at creating 1 million jobs for young people. And we saw how hard that was. One, we needed to change legislation. So being really intentional around where's legislation a big barrier as it relates to creating jobs. Secondly, how do we then better invest into SMMEs? I think all three of us have really highlighted the need to invest into SMMEs, who are the big job creators in most economies. And so I think we cannot, from an investment perspective, underpin how important it is to invest into SMMEs at different stages. And I think when we think about investment opportunities, it's also really thinking about what are fit-for-purpose capital mechanisms or instruments that are needed. And so really rethinking, how are we investing? Are we supporting very job-accretive sectors? We spoke about the importance of agri, the importance of manufacturing. What are the sectors that are really going to drive jobs across the continent? And yeah, I think maybe just as a final point is, I think the African youth is not a risk, but really a resource to be cultivated over the next couple of years. And I'll stop there. Thanks, David.
Youth only becomes a risk when you don't cultivate it.
Correct, yeah. And it becomes a global risk when we don't cultivate it.
And,
That's a good
Kim, go
segue
ahead.
to what happened in Kenya. Anne?
That's true. If anyone remembers, last year, in June of last year, there were the Gen Z protests in Kenya, which were as a result of many things, but primarily one, rising unemployment, and two, a massive tax burden on people who are already either unemployed or underemployed. And I think it's a ticking time bomb across the continent that if we don't resolve now, we'll have massive generational consequences, not just for Africa, but to the countries and to the nations that the youth are emigrating to. I don't know if we have anyone here from either Ivory Coast or Cameroon. Thank you. Côte d'Ivoire. Yeah, how old was the president that Côte d'Ivoire is re-elected? Thank you. So Côte d'Ivoire just re-elected an 83-year-old president. Cameroon, he's 92 years old.
Well, I think
Sorry,
the United
94.
States has an old president as well.
Much as your demographic, though.
Right? And so we keep electing older and older leaders, well, they're not truly elected, quote unquote, but we have much older leaders leading younger populations, and there's a lot of insulation. They sort of insulate themselves from the problems that the countries are facing. And so I don't think that we can always look to the political class for the solutions that we need to really address the youth demographic opportunity. It's not really a problem unless we don't do anything about it. It really is a youth opportunity on the continent.
Well, thank you. So if you have a question for our panel, I think the flashcards are going around. Oh, thank you. So before we get to audience questions, I wanted to ask you, obviously you've been working in this field for a while. What lessons have you learned about impact investing in your countries, in your markets, that you could share with the audience?
Yeah, so I'm really passionate about impact investing, and I think what's really needed specifically, and I think I'll address it as an Africa response, is, so I do a lot of work with the University of Cape Town, as they've got an executive program called Impact Investing in Africa. It's the only executive program or course of its kind that's really educating people around what is impact investing. And so every year we potentially have a cohort of about 50 people who are coming into the course. We've had an alumni base of over 500 people, which is really tiny compared to the fact that the continent has 1.4 billion people. And so, one, there is a lot of education that needs to happen. And I think also being mindful of the fact that impact investing is really one of the most scalable and sustainable ways to solve some of the developmental challenges that we've highlighted on the continent. So I think that's an important aspect around how do we educate more around what impact investing is and why it is really needed, firstly. Secondly is, given the low education or not many people being exposed to what impact investing is, as a result, fundraising, and I think in our experience, trying to raise a $22 million fund, it's a $22 million impact fund. Oftentimes when you say impact to traditional investors, they think they're giving up commercial returns. When you speak into foundations and foundation endowments, the moment you mention investments, oftentimes they think it's outside of their scope. And so I think, the education piece is really important, but the impact of that then becomes that fundraising takes really long across the continent, and maybe it's the reality of many other fund managers who are raising impact funds globally. So fundraising takes long. There is an opportunity there, which is, what that means is you then need to sustain working capital over really long periods of time. On average, fundraising will take anything to 36 months. Oftentimes investors want to see a full team. And so how do you then build a team? We've got regulation and all these other costs to ensure that you get to, one, a first and then a final close. So I think the first one is appreciating that low levels of education around certain areas result in longer timelines in fundraising. Secondly, I think it's really understanding that relationships are key. I don't think I need to go into too much detail around that, but really understanding your stakeholder base, who's aligned to the objectives that you have as a fund manager. I think thirdly, really being excellent. And excellence is such an important value. It's something we really believe in. We're investing in really tough markets, and so ensuring that you understand the market, the opportunity, and that you are backing the right organizations and entities. Another area is really being clear, around the value that you bring, one, to your investors, but also to your investee companies. So to the example that Anne made around why they did is so catalytic, is there's clarity around what the value does in that market and what the impact is for that ecosystem. And so similarly in our markets, understanding some of those systemic structural exclusions, and so what does our capital then enable in the South African market? And I think my plea is to continue being persistent, and then maybe just quickly touching on some of the successes we've seen from a fund perspective. One, getting to the $4.8 million allocation is, we're really excited. We've seen the team expand. We've also, some of the advisory work we've done has unlocked over 55 billion rand, no, $55 million, my apologies, in impact capital into the local market. And so I think when you are educating, you are then seeing the flows of capital following that. We've also been part of a number of fund manager programs, have also been awarded, I think maybe speaking back to some of the working capital, is we're able to get some grant allocation, one from Equity and Green, which is a global organization supporting social justice entrepreneurs, and then secondly, also most recently, got allocation from the African Women Impact Fund. And so I think there's a lot that's happening. We're still really excited about the work we're doing. We really believe in it, but most importantly, believe in the quality of our pipeline and what we'll be able to deliver, both for investors, but also for the investee companies. I'll stop there.
How about you, Kim?
Thank you, David. I mean, Shiluba speaks too much, has spoken already too much of what the lessons that we've learned. Most of them are extendable across the continent. I guess I would add just a couple of personal successes, and then one thing that I think that we're still failing or figuring out as an ecosystem. So 17 years ago, I foolishly quit my job as an investment banker at Goldman Sachs and moved to Uganda to be the first person to be a resident equity investor in the market and develop an ecosystem. One could call it the folly of youth. I would call it I would call it the courage of youth. And what I've learned in those 17 years is, first of all, less learned and more proven. I've proven that what I came to do works. The very first investment that I did in 2008, and I was looking around to see if Zain was in the room, because Zain from TLG is the person with whom I did that investment, and I thought he would be here, but he's not. The very first investment we made in March of 2009 it was a venture investment actually. It was pre-revenue, let alone pre-profitability. It was a ticket that our first ticket was under $1 million. It was predominantly from friends, family, and punters, as we're now calling them. And that investment became the first manufacturer of HIV, AIDS, and malaria drugs on the African continent. Wow. It became the first family business in Uganda to list on our stock exchange. Within 9 years of writing our first check to them, again of under $1 million, they listed on our stock exchange for $250 million, $250 million. It proves that what we do works. What we do works, and we crowded in almost $70 million of equity into that business and demonstrated for the first time. We have a stock market that at the time had only 10 companies, all of them foreign. And foreign subsidiaries as well, which is like not even a real stock market. But we demonstrated that what we do works. And for me, that's really the first lesson. Trust us, because what we do works. The second lesson that I learned is that active management changes the game. I insisted on moving to Uganda and becoming resident there because I knew, having been a child of an entrepreneur myself, that these companies predominantly needed capital, but not only capital. They needed what I had learned by being an equity investor globally. They needed to understand and have guidance of how to scale a business from the small scale to the big scale, how to deal with big issues, risks, to have somebody there to walk with them. We have an extremely active management style. It is very non-cost effective for me and my team. So much so that we are possibly a modern slavery organization. But it has unleashed value in the companies that we invest in a way that I can't explain to you, because the combination of them having capital and a global mindset and a partner that takes them along the way, builds their capacity, we have unleashed 100 times the value and literal financial value in almost at least in 70% of the organizations that I've invested in those 17 years. So I've learned that active management works. Now the problem is that funders, you don't want to pay for it, which is unfortunate. But we have to remember that in Uganda, and that same period, 80% of businesses do not reach their second birthday. So capital is the problem, but more than capital is the problem. The last lesson that I will share, or success that I will share, is double-clicking on that and saying investing in women works. Our first investment at Inua Capital is in a lady who makes porridge. When we met her, she was making porridge in her home what started as for her child. And it sounds all really very rudimentary, but it's not, because we don't really invest in decks. We don't really invest in people who approach us looking for capital. Rather, we look for products, services, and people who we think are doing something special, and we thought she was doing something special, and we approached her.
So let me jump in here and ask a follow-up question, because I need to get to Q&A.
Apologies.
So one person asked about whether you offer any technical skills training to your investees.
Okay.
If you can
I'll add
weave that in.
Yes, and this is a good example. So we invested in this lady, and when we invested in her, she was doing $300,000 in revenue. Within now 24 months, she's 10 times that and doing $3 million in revenue. In that period, we've helped her complete a 1-year MBA, focused specifically on entrepreneurs, and so we do that in terms of supporting with that, but they have to want to do it. We've also given her a chain of female entrepreneur mentors. And we have set up for her a board of directors, and we fund 3 independents, 2 of whom are women, to support in developing her business and building her capacity that way. So it is definitely a part of what we do. But I'll just pass lessons learned also on to Anne to hear from her on that.
Thank you, Kim. I realize we're also running short of time. The timekeepers are itching in the back. So I think Kim and Shiluba have captured it very, very well. We are doing very difficult work under very difficult circumstances with very limited funding. And the reality is, I think we're all here in the room because we recognize that you need a multi-sector, I think what I had yesterday called a polysectoral approach towards solving problems, not just globally, but especially on the continent. So capital alone is not enough, but the capital we have is not enough. There's a over $300 billion gap when it comes to funding SMEs, small and medium businesses in Africa, and imperfect inaction is worse than imperfect action. So do the little that you can is much better than not doing anything at all. I think I've learned that the perfect should not be the enemy of the good, right? So you can't have a perfect business, a perfect fund structure, perfect management fees. Like none of that just isn't going to work on the continent. In the short time that Sayuni has been active since last year, we've now committed and signed $750,000 to 3 SMEs in Kenya, but it's been a lot of work to be able to do that. I had a saying yesterday that the science is out, that we are facing large problems, but the jury is still in. Do we have the courage to be able to address some of these challenges that we are facing? And so my hope is that I think all of us collectively, and the 3 of us don't represent the universe of solutions in Africa, right? There's a lot of people doing excellent work in venture, in climate, in solutions, in health, in education. But I think we really need to start attacking the large problems we face on the continent. I'll finish with a bit of a made-up quote, which is that a cat that aspires to be a lion needs to stop chasing after rats. Right? So let's start really going after the big problems we're facing on the continent.
I want to ask a follow-up. One person in the audience asked, what is your ask for investors in this room outside of capital? Of course, they'll take capital too, but...
Yeah, I mean, when you said ask, I was like, capital. I think it's really important, the capital conversation. Firstly, I think community is really important, and so how can investors who maybe can't commit for whatever reason to some of the managers that are sitting on stage here is how do you make connection? I think that's an important area. So one, capital, can't run away from the capital. Secondly, how do you think around connection? Thirdly, community. We're all part of a grouping called CFF, which is the Collaborative for Frontier Finance, which is a collective of over 120 fund managers operating in emerging markets, majority of those on the African continent, who are really deploying really innovative instruments throughout the different markets on the continent. We've got, I guess, 54 countries in Africa. And so when you think about South Africa, when you think about Uganda, when you think about Kenya, very different dynamics, very different realities. But I think all of us are really aimed at a common good. I think also key could be maybe some level of technical support, assistance to managers is, for many of us, we're going into, as and mentioned, really difficult markets and doing really difficult work. And so some level of support, mentorship, guidance, really availing yourself to assist in any way possible. But I'm not sure if maybe the rest of the panel can also add.
If I may also touch on that, echoing everything that Shiluba says, but I have one very specific ask to funders in this room. Enter the controversy. Understand that our model, if you believe in funding or supporting the missing middle and SMEs, understand that our model is expensive. And a 2 and 20, 3 and 30 model can never work, because as we have just described to you, it is very active work. It requires a lot more than capital. It is very resource intensive. And therefore, if you insist on this structure that was never created for our industry, and creates essentially an unsustainable business model for the funder, what you do is either pass that cost on to the companies, which they can't afford, and you're trying to reduce the cost of capital to the company, but somebody has to pay the check. And it cannot be the fund manager because they don't have any capital. So as the funder, you need to recognize the right structure to fund SMEs, or we will either pass the cost on to the companies, which makes them more likely to fail, or not give them the support they need, which makes them more likely to fail. Success is a function of the right business model.
We've had several questions from the audience on education. I will ask one of them. It's clear from all the data that a culturally relevant education that empowers the next generation to build power from the ground up, it's clear that it's important. Where outside of government can we get the funding to do this education, including curriculum creation?
I mean, so happy to step in there. I'm not in any way an expert in education, but the reality is I think we need to start focusing on skills-based and vocational education to really create employable graduates, as well as really help them to, I think beyond how do I get employed to how do I also start my own businesses. I think that's going to be extremely critical for the continent. One of the first investments that I did as an investor was in an ed tech company that was providing coding skills and largely to university graduates. Because what would happen is that you have a computer science graduate in Kenya who took coding exams on pen and paper. And so they leave university with a computer science degree, likely having learned outdated languages like COBOL, coding on paper. But the reality is they don't understand what a front-end interface looks like or how do you build a strong back-end. And so you really need, unfortunately, solutions that come in to address systemic issues. But again, they are, I'd say, a good next step rather than inaction and not doing anything.
Oh, you wanted to add, Shirley?
Yeah, I did want to add. I think also what we've seen work well is partnerships between private sector, public sector. And so when we think about education and curriculum, oftentimes the private sector is absorbing these young people who are coming from different educational institutions. And oftentimes they'll complain about the quality of education that the young people have received, but also the fact that oftentimes the curriculum is outdated. And so I think what's worked well is where private sector is stepping in and working very closely with university around what is actually relevant curriculum. One is really important. We've also seen how private sector is also supported with curriculum development. And so because they clear around the skills and the competencies that they're wanting to get from the workforce, they're then working with educational institutions to ensure that they are getting those. I think a key one is also around entrepreneurial education. There isn't enough of that that's happening on the continent. We speak about the fact that 80% of employment is going to take place in SMMEs. We're asking young people to start creating their own enterprises, given there aren't roles in formal employment to absorb them. And so how do we start training young people to think around what does it mean to start a business? How do you ideate around an idea? How do you think about solving? How do you employ people? What are the different taxes, policies that are in place? Oftentimes young people are really unclear on that. And I think a last point is, and it's something we're doing, where every year we take in 2 interns. The reason for that, we're highly passionate about impact investing. Nowhere in any university currently at an undergraduate level are they teaching about impact investing. And so you're getting this great solution and this great approach where young people are not aware of it. And so we're then getting young people coming into deal-making roles, getting the exposure. Oftentimes in finance classrooms or investment classrooms, the education is really limited. And so we're doing a lot of training over, we recently hosted a 10-week internship. We're currently going to open recruitment for a 5-week internship. It is a paid internship, but I think key for us is really starting to transfer necessary skills, but also providing the right exposure to young people around what is feasible and plausible as career options. I'll stop.
So I have another question here. It's directed to Kim. How many businesses have you managed to exit, and what are the exit strategies that you're employing given the underdeveloped equity market?
Who's picking on me? You should have like a... No, it's a very good question. I think that, first of all, for us, we structure for the situation, and that is including the entrepreneur, the market, and so on. So even when we do self-equity investments, we can make them self-liquidating, so that if we don't necessarily have to exit to a strategic or to the exchange or anything like that. But actually, I'll be honest, since 2008, exit has not been my primary challenge. When you build a very good business in a market, people will come to want a bit of it. Also, if you build a very profitable business, the founders that you have built will be able to buy back their equity or refinance it, for example, with a bank, because we invest in businesses that have zero bank capital. So we have predominantly focused on exiting the following ways. One, I've mentioned one big exit, that was the exchange, but it is not the norm. In fact, it's the only exit on the exchange, and it was very much a surprise, I must say. We didn't build it to exit on the exchange. We built it to exit to another private equity investor. We knew that we would build something that the secondary markets would like. Secondly, secondaries is a very big one. As a local private equity investor, you find gems, you grow them to be sustainable, and continental investors want to take them to the next level to regionalize them. Secondly, refinancing to less risk capital providers. So we actually have banks are desperately looking for business in Uganda. They just want really low risk business. So our arbitrage is to de-risk businesses and get them to a level of de-risking and collateral where traditional finances are interested in them. And lastly, and maybe most importantly, people love to buy their businesses back. I think it may be an African thing, I don't know. But we always, somewhere in the middle of our journey, get the founder saying, thank you so much, it's been so great, can I buy your equity back? And I'm happy. And we put options on them to do that if they so choose.
And one question here, do you invest outside of the countries you've spoken about, South Africa, Uganda, Kenya? This person asked about Botswana, but...
Yeah, sure. I'll start. So Sayuni invests in Kenya and Tanzania, and aspiring to also move to Uganda.
You're very welcome. No, I have gone exactly the reverse way. I started with a continental fund, and then went to East Africa focused funds, and then now a Ugandan focused fund, primarily because of the reason that I mentioned earlier, that we find that it needs to be very active, both in terms of the work of investing in a fund as an equity fund manager, but as she mentioned, around training Ugandans and bringing people into the investment space. And so having traveled for so long in the beginning, I realized that it was hurting the quality of my portfolio. So at the moment, I invest in only Uganda with the possibility of putting capital into Rwanda and Burundi, which don't have an ecosystem for private equity, but with a core market as a focus.
Yeah, I mean, I think nothing further to add. We only, and at the moment, invest in South Africa. We are an emerging fund manager, so it just makes sense to focus on the landscape that we currently are invested and positioned in. We do have aspirations to be in Southern Africa as a region. My mother spent 6 years in Botswana. I know the country really well, thoroughly enjoy Gaborone. I'm Tswana, so I speak the language as well. I speak 5 others, but that's another story for another day. And so, yeah, we, currently don't invest in Botswana, but the aspiration is to extend beyond that. I also just wanted to quickly maybe touch on a point that Kim mentioned around stock markets on the continent. I just want to make sure the audience doesn't walk away thinking we have very small stock exchanges across the continent. So I used to be a corporate finance officer at the Johannesburg Stock Exchange, which is the largest stock exchange on the continent. At its peak, we had over 600 listed companies, large market caps. I think, so I was in the team that was essentially getting companies to listing. There were days we were listing 2 companies at a time. And so, you know, I think depending on the market, depending on the activity, there could be a lot of activities on stock exchanges. What was really interesting also around the JSE, and I'll stop quickly, is one, we had your main board, which is for much larger established organizations. You also had the Altex board, which was for smaller entities. And then one of the works that we, and I guess was part of thinking around, is how can the Johannesburg Stock Exchange, as the largest stock exchange, better support SMMEs, and what does that look like? And part of that work really resulted in setting up a private placement platform to connect SMMEs with capital providers and investors. And so there's some really interesting work taking place since, I guess I was at the JSE, left in 2016. There've been a couple of other stock exchanges in South Africa alone. So we've got the Cape Town Stock Exchange, Altex, AIM, and a couple of others. And I do want to emphasize the Johannesburg Stock Exchange was the most regulated stock exchange 5 years in a row. And so the organizations and entities that were coming to the market, well regulated, great communications, a very big investigations department. We did a lot of proactive monitoring of the organizations, but really aimed at ensuring that whatever companies were reporting was in the best interest of the public.
Well, thank you. That's all the
David,
time we have for. Oh, go ahead,
Can I
Ann,
just,
if you want
just to
Kim,
add on to
Steve.
that, because it's a really
Real quick.
important point,
Yeah.
because this is an area in which you have an African country that's a global leader. South Africa has the biggest market cap on its exchange to economy, and it has been a big driver of economic transformation in South Africa for 30 years. So I think it's a very important point. Thank you, Shluba.